Hi folks, welcome to Real Estate Rundown. I'm Lori LeCompte and I'm a real estate agent in Northwest Arkansas. Today I want to talk about down payments. A down payment on a house is the cash that the buyer pays up front in a real estate transaction. It's the money you put down on your mortgage. It's due at closing and is usually the most expensive closing cost you'll need to budget for. Down payments are typically a percentage of the purchase price and can range from as little as 3% to as much as 20% for a property being used as a primary residence. The required down payment amount is typically determined by the type of mortgage you choose, but your financial situation and the type of property you're buying, for example, primary residence or investment property, also comes into play. Now, lenders express down payments as a percentage of the total loan. For example, if you buy a home and the loan amount is $200,000, a 10% down payment would be $20,000. You've probably heard people say that you need a 20% down payment to buy a home. The reason you hear a lot about a 20% down payment is that 20% is the minimum amount you'll need to avoid having to purchase what's called private mortgage insurance. And I'll talk about private mortgage insurance in another video because we've got a lot to cover today about down payments. But quickly, private mortgage insurance protects the lender in the event that you default on your loan. Now again, 20% is not the minimum down payment you need to get a loan. For a mortgage with as little as 3% down with a conventional loan, which is the most prevalent type of mortgage. If you choose an FHA loan, the Federal Housing Administration, you'll need a 3.5% down payment. FHA loans require less money down and lower credit criteria. You can even buy a home with 0% down if you qualify for a VA loan, a Veterans Affairs loan, or a USDA loan, which stands for United States Department of Agriculture. This type of loan was created to encourage the buying of properties in rural areas. Now don't panic. Your lender will explain and guide you through all the loan options for which you qualify. Well, why do lenders require a down payment? Well, when your mortgage lender gives you a loan, they're taking a risk on you. If you stop making mortgage payments, it's possible that the lender won't be able to make back the money they lent you. Putting money down helps mitigate risk for the lender in a couple of ways. It represents your investment in the home. If you were to stop making payments on the home, you'd be walking away from the thousands of dollars you put into it. It also lowers the amount the lender has to give you for the purchase. If you're paying 20% of the purchase price of the home, then they're only lending you 80%. Then that's less money they'll need to worry about getting back if you stop paying. It's important to note that the down payment requirement isn't set by the lender alone. In many cases, the down payment requirement comes from the investor of the loan, which may be the Federal Housing Administration, Fannie Mae, the Department of Veterans Affairs, or some other organization. Now let's talk about how your down payment affects your interest rate. The size of your down payment has a direct impact on the interest rate your mortgage lender will set for your loan. The larger the down payment you offer your lender, the lower your interest rate may be. And of course, a lower interest rate means lower monthly payments and less interest over the life of the loan. On the other hand, if you decide to put less money down, you might end up with a higher interest rate on your loan. Now here's a down payment example. Let's say you want to purchase a $300,000 home and you've saved up $30,000, so a 10% down payment with a 30-year mortgage. So the balance of your loan would be $270,000 because you're coming up with $30,000 for down payment. We'll divide that between 360 months, which is 30 years. Now, without considering interest, taxes, or insurance, your monthly payment in this example would be about $750. Now, let's say that you put down 20% instead, 20% down payment. This would lower the principal amount of your loan to $240,000 on a 30-year mortgage. So your monthly payment would be $667, again, excluding interest, taxes, or insurance. Though you'd pay more up front, the principal portion of your monthly payments would be about $83 less. That might not seem like much, but also not the full picture. Using a 20% down payment to buy a house could save you hundreds of dollars a month on mortgage insurance, and it could also mean a better interest rate. So now you're probably thinking, lady, you just told me I don't need 20% down. I totally do. So let's talk about some of the factors to consider when deciding what the best down payment option is for your situation. So both large and small down payments have benefits. It's important to understand them and carefully consider your own personal financial situation and goals before making a decision. Benefits of a large down payment. So number one, lower rates and premiums. Lenders love to see large down payments because it lowers the risk you pose to them. The larger your down payment, the less you have to pay each month in both principal and interest. Think of a down payment as an interest-free way to get a jump start on paying off your home. Number two, avoid mortgage insurance. Certain types of loans require you to pay mortgage insurance. On a conventional loan, you generally need to put down at least 20% to avoid paying private mortgage insurance, which is usually a monthly fee that you pay as part of your monthly payment, or it's paid up front by the lender in exchange for a slightly higher interest rate. Number three, lower debt to income ratio. Your debt to income ratio represents the portion of your monthly income that goes towards paying off your debt. A lower DTI means you have more borrowing power in the future. A high DTI can prevent you from getting other loans or credit. So a lender may determine that you can't take on any more debt than you already are taking on. So with a larger down payment, you're borrowing less money, so this could mean that your DTI is now more manageable. DTI's standards and guidelines vary by lender and loan type. If you're not able to make a large down payment at the time of the purchase, you still may be able to reduce the amount of interest you pay on your home by making larger payments to your mortgage principal. Many homeowners are able to do this if their income increases over time. Or maybe you want to pay a little extra for a couple months because you got a bonus at work. The process of making larger payments in order to pay off your mortgage faster is sometimes called accelerated payments. Now, the benefits of a small down payment. Number one, you can buy that home sooner. A 20% down payment can take years or even decades to save for, depending on your income. A lower down payment can help you own a home sooner, so you can get in there and start building your equity. Number two, money for repairs and renovations. Emptying out your savings for your down payment might not help you in the long run. As a new homeowner, you may find that you need more money for repairs and renovations than you thought. So setting aside the money up front can make homeownership less stressful. Number three, keep an emergency fund. You won't have to dip into your emergency fund. Keeping some money in the bank for emergencies is a smart move. You don't want to have to pay for unexpected car repairs or medical bills on credit. Hanging on to some of your money could give you peace of mind and be a cheaper way to cover emergency costs. The bottom line, with down payments, there are many factors to consider when it comes to determining how much of a down payment you'll need. A lender can guide you through the different scenarios so that you can determine the down payment amount that works best for you. Thanks for listening. Feel free to comment down below about real estate topics you'd like me to talk about in the future. Knowledge is power.